Welcome to the Deep Dive. We're here to cut through the noise, get straight to what really matters in corporate earnings. Today, we're taking a close look at Albertsons Companies, their first quarter fiscal year 2025 earnings call. Now, this is a really crucial read. They're the second largest pure play U.S. grocer. We're talking 2,270 stores. Our mission here is simple. Dig into their recent announcement, pull out the most important nuggets, and help you understand the real story behind the numbers. And, we'll be exploring whether Albertsons' big strategic gamble, sacrificing some short-term profit for long-term customer value, is actually a masterstroke or maybe a misstep. It's a tough market out there. So let's jump right in. The headline numbers. On the surface, they look pretty good, right? Albertsons reported revenue, $24.88 billion. That actually beat the consensus estimate of $24.71 billion. And their adjusted earnings per share came in at about 55 cents. Also topped the Street's view, which was 53 cents. Identical sales growth was 2.8%. And notably, that was driven by, very strong pharmacy performance and a pretty significant 25% jump in e-commerce. So yeah, clear top line momentum.
Yeah, but what's really fascinating here and kind of the crux of it is despite these beats, the initial market reaction was, cautious. The stock actually saw a pretty significant rotation out, dropped over 5% right after the call. And the key insight, I think, is that the market wasn't just looking at that top line. It really fixated on other things, particularly the gross margin. That slipped 70 basis points, so 0.7 of a percentage point. And this reaction, it really reflected a keen focus on how they got those revenue gains, through continued investments in pricing. So yeah, revenue strength, definitely. But it came with this more nuanced picture of thinner margins. And digging a bit deeper into those financials, that 70 basis point contraction in gross margin year over year, management basically said, look, that was deliberate. It was an outcome of strategic price investments. They're trying to enhance their customer value proposition. That was the goal. It was also hit by a mix shift. Strong growth in lower margin pharmacy and digital businesses. Now, they did say productivity initiatives partially offset some of that decrease, but the core insight, and they were explicit about this, is management's focus on growing gross margin dollars and EBIT dollars, not just the rate. It's a really clear signal they're playing a longer game here. Valuing overall profit growth, over the margin percentage itself.
Okay, that's a really crucial distinction, isn't it? So if they're making those kinds of deliberate investments, the ones hitting gross margin, how did they manage SG&A, selling and administrative expenses? Did they find ways to leverage those costs?
Absolutely. Yeah, they did. They reported a notable 63 basis point improvement in the SG&A rate, excluding fuel. And this was driven mostly by ongoing productivity initiatives, leveraging employee costs, basically getting more efficient with their workforce, and also lower merger-related expenses. After the Kroger deal didn't happen, they gave some specifics too, like the new tech headquarters they opened in India and transitioning back-end accounting functions to an existing place they have in the Philippines. So yeah, it's a good example of finding efficiencies to kind of offset those other pressures. And then if you look at their capital allocation, Albertsons invested $585 million in capital expenditures just in the quarter. That went into opening 3 new stores, completing 36 remodels, and importantly, modernizing their digital and tech capabilities. They also returned $401 million to shareholders, dividends, and share repurchases. And they still got about $1.5 billion left in their current multi-year $2 billion share repurchase authorization. Oh, and their net debt to adjusted EBITDA ratio stands at 1.96. Pretty manageable range for a company this size.
Okay, so beyond just the immediate financial numbers, where is Albertsons really putting its energy for future growth? Management laid out these 5 strategic priorities. Seems like these are really central to their plans. Driving customer growth and engagement, through digital connection, growing their media collective, enhancing customer value proposition, modernizing capabilities with tech, and driving transformational productivity. Seems like these are the core areas they're really, really zeroing in on.
Indeed, yeah. And within those priorities, there are 4 key digital platforms. They're proving to be absolutely crucial catalysts. So first, you've got e-commerce, grew a really robust 25%, and it's now nearly break even, which honestly is a significant improvement given the historical challenges of making money in online grocery. This is driven by more volume, better labor efficiency, smarter transportation cost management. Their store fulfillment model helps too, right? Creates efficiency because the stores are already there, close to the customer. And they're adding things like AI features, shop assist, flexible basket building. Customers can even add items right up until picking starts. So yeah, big focus there. Second, their loyalty program saw 14% growth, now at 47 million members. That's huge. And it's not just, a points program. It's key for digital engagement. And it's a really rich data source for their media collective. Interestingly, they said 30% of engaged households are now choosing the cash off option, which reinforces that desire for immediate value. Smart move. Third, pharmacy and health. Grew an impressive 20% year over year. About half of that growth came from GLP-1s, the Ozempic, Wegovy type drugs. But core prescription growth was also very strong. And these cross shoppers, the ones using both grocery and pharmacy, they're exceptionally valuable. Visit stores 4 times more often, drive outsized customer lifetime value. So Albertsons investing here. Higher margin services like test and treat, immunizations, improving sourcing, automation, just opened their 3rd central fill facility. This also gives them a competitive edge, as other competitor pharmacies might be shrinking availability. And finally, their mobile app, they call it the Swiss Army knife for the omni-channel experience, driving digital engagement almost 3 times a week on average. Integrates meal planning, search, in-store stuff. So the big takeaway from this digital push, it isn't just the growth numbers, it's how they're using these platforms to build like a powerful pharmacy moat and that data-rich media collective, fundamentally reshaping customer relationships.
Wow. Yeah. It sounds like all these digital initiatives must be generating just a huge amount of data. Is that where the media collective comes in? And how big of a game changer is that supposed to be for them?
It absolutely is. Yeah. The media collective is growing faster than the overall retail media market. They're significantly increasing their high impact digital inventory. Management clearly sees it as, a major future source of fuel, money to reinvest back into the core business, supporting both endemic partners and the brands they already sell and non-endemic partners too. Brands that don't usually sell groceries but want to reach those shoppers. It's a big deal. And then on the customer value proposition side, they've made these intentional price investments through loyalty, promos, vendor partnerships. They've also really amplified their own brands. Own brand penetration is now at 25.7%. And they're aspiring to get over 30%. New launches like Overjoy, that's their premium coffee, and Chef's Counter, their ready-to-eat meals, that's all part of the strategy. It reminds me how much I appreciate those store brands when I'm trying to save a few bucks, so it clearly resonates, right? And these efforts, they said, are already delivering sequential improvement in grocery unit sales. So it seems to be working.
Okay, so with all these strategic initiatives going on, what's happening on the tech and productivity front? To power everything and keep those costs in check.
Yeah, that's where their technology, modernization, and transformational productivity initiatives really intertwine. They're taking a technology-first approach, leveraging AI for, almost everything. Pricing, promotion strategies, personalization for individual shoppers. Specific productivity drivers, things like automation in their distribution centers, predictive scheduling for store labor that's about like wall-to-wall forecasting to get staffing right, pilot programs for electronic shelf labels too, which are showing great results apparently in cutting down manual labor. They're even using vision AI and self-checkout to improve shrink, reduce losses from theft or errors. But the biggest opportunity, they said, is leveraging their consolidated scale for national buying. They expect that alone to deliver a massive $1.5 billion in productivity savings from fiscal year 25 through 27. Huge number. So looking at their guidance and outlook, Albertsons actually raised their full year identical sales guidance. It's now in a range of 2 to 2.75%. That's up from their previous 1.5 to 2.5%. And this is primarily driven by that continued growth in pharmacy and digital sales, with an assumption that grocery units will gradually increase too. Now, they do expect the second quarter's identical sales to be towards the lower end of that range, partly due to a tougher comparison in pharmacy growth from last year and also the impact of a recent strike. But they anticipate acceleration in the back half of the year.
Right, and here's the really interesting part, isn't it? Despite raising that top-line guidance, their adjusted EPS and EBITDA targets for the full year, they remain unchanged. What does that tell us about their priorities right now?
Yeah, that's the pretension. That unchanged profit outlook, it reflects their continued deliberate investment in that customer value proposition. And it reflects the near-term margin headwinds from the high growth of those, lower margin pharmacy and digital businesses. It's basically a strategic trade-off they're making right now. They're essentially saying, look, we're investing now for future gains. However, they are reiterating their long-term outlook for fiscal year 2026. They expect that to align with their long-term growth algorithm that's 2% plus identical sales and higher adjusted EBITDA growth. So that suggests they really do see these investments paying off down the line. Now, zooming out to the investor context, the market's reaction was pretty telling. Investors applauded the revenue beat, sure, but like we discussed, they really fixated on that margin erosion and the unchanged profit outlook. And that led to that significant rotation out of the name we saw. It's worth noting, too, other grocers also traded cautiously, so it signaled maybe a sector-wide concern about cost inflation. It wasn't totally isolated to Albertsons.
Okay, so putting this into a wider context then, what's happening across the broader industry landscape, and how is Albertsons kind of navigating that?
Well, the competitive pricing environment, they described it as rational, but there's definitely continued promotional investment, especially from, mass market guys and club stores. It's a tough fight for the consumer's dollar. Consumer trends, still highlighting that persistent search for value, which you see in increased promotional sales and that strong lean into own brands, which is exactly why Albertsons' focus there is so relevant. They saw some interesting category shifts too, like increased sales in pork and ground beef that reflects value seeking, but also strong growth in deli chicken for those quick, convenient meal solutions. People are busy. On macro trends, they mention it the indirect impact of tariffs on their CPG partners' costs, which, prompts Albertsons to push back on vendors, but also actively explore more own brand expansion as a kind of solution. So yeah, it's a dynamic market. Everyone's adjusting.
Okay, so given all of that, what really stands out to you about how Albertsons is positioning itself in this market, especially with this focus on driving units and customer lifetime value through these big strategic investments?
What's crystal clear, I think, is that management is wholeheartedly prioritizing unit growth and customer lifetime value. That's the mantra. They are banking on their really robust productivity initiatives, especially that massive national buying power they're consolidating, and their tech modernization efforts. They're banking on those to eventually provide significant tailwinds to margins and to drive future profitability. It's a very deliberate, very long-term play, even if the market isn't, immediately rewarding it right this second.
All right, now for our This Is Not Financial Advice segment. Just a reminder, these are purely speculative ideas, just for discussion. Please always do your own thorough research.
Okay, all right, so here's an idea. Might seem a bit outrageous, maybe, but plausible for those with a longer time horizon. Consider, maybe, a long position in Albertsons Companies, ACI, coupled with a short position in a peer grocery chain, one that's not showing the same kind of aggressive investment in digital transformation, pharmacy expansion, and those long-term productivity initiatives. Now, the rationale is this. The market is currently punishing ACI for its intentional near-term margin compression. That's the key word, intentional. This isn't really a sign of weakness. It's a strategic investment designed specifically to build higher customer lifetime value through deeper digital and pharmacy engagement. And the company has this clear, quantified path to significant productivity savings, that $1.5 billion through fiscal 27, particularly from national buying and tech modernization. Now, this is expected to provide a tailwind to gross margins, probably starting in the second half of 2025. And it's projected to drive a reacceleration of EBITDA growth in 2026. So this creates a potential valuation disconnect right now, you see. The outrageous part, I guess, is betting against that immediate market sentiment. Anticipating that ACI's foundational shift, their modified high-low pricing strategy, combined with that unique pharmacy moat and tech-driven efficiencies, anticipating that will lead to disproportionate outperformance against, let's say, less agile competitors over the next maybe 12 to 18 months. It's a bet on the strategy paying off.
Okay, so just to recap the main points here. Albertsons delivered strong top-line beats, driven by digital and pharmacy growth. But the market reacted cautiously, focusing on those deliberate margin investments and the unchanged near-term profit outlook.
Exactly. And ultimately, management's long-term vision is pretty clear. It's a pathway to sustain growth and improve profitability, but beyond fiscal year 2025, driven by these strategic investments and those big productivity initiatives they keep talking about.
So here's something for you, the listener, to think about. As you consider the broader grocery market, does Albertsons' strategy, this near-term margin sacrifice for long-term customer engagement and productivity gains, does that signal a shrewd play for future market share and profitability? Or, does the market's initial skepticism hold more weight? And remember, one last time, this deep dive is purely for informational purposes. It is definitely not financial advice. We always encourage you to conduct your own thorough research.